Thank you, Matt. So we've broken down the presentation in two. In the first part, the idea is to basically discuss our latest views on China, on whether we think that the ongoing slowdown that the economy is experiencing so far will extend into 2022 and beyond. And then with that, I'll then move on to our views on commodity markets, discussing how China's outlook will affect commodity investments over the coming year. And I'll also delve into alternative assets that are also heavily exposed to China, focusing on emerging market stocks broken down by region, so covering Asia, EMEA, and Latin America. So to start off with our views on China, as I'm sure you've seen in the financial press, there's quite a bit of concern at the moment of the speed at which China has lost momentum. If you go back to this time last year, China was by far the economy that had recovered the fastest from the initial COVID shock. It had very quickly, through ample amounts of fiscal and monetary stimulus and through a favorable exposure to goods and not so much to services, it had recovered very quickly from the COVID pandemic. But this year, we're basically starting to see these trends that benefited China last year reverse. The chart that you see in front of you here shows global GDP by region in the second and in the third quarter of 2021. So this is quarter-on-quarter growth for the global economy as a whole and its main subcomponents. We estimate that economic activity in the third quarter of this year rose something like 6% quarter-on-quarter annualized, which is clearly well above than the average rate of growth or the trend rate of growth of the global economy. Just to give you an idea, our estimates of potential growth for the economy as a whole worldwide stand at around 3.5%. So you're basically looking at twice the rate of growth than you would typically see at potential. Now, if you break that down by region, however, you see significant differences in performance, with the euro area, which was much more affected by COVID late last year and early this year, outperforming. It's growing nearly 9%, maintaining the pace of growth that it hit in the second quarter. And perhaps surprisingly, both the US and China are actually a drag on global growth. The figures for China are particularly concerning. The quarter-on-quarter estimates for China on an annualized basis show basically the Chinese economy flat. You probably saw the headline figure of around 4.5%. That's basically the year-on-year comparison for China. But compared to the second quarter, basically China barely expanded. And with the exception of the second and third quarter of this year, when you had very strange effects due to COVID, you'd have to go back more than 20 years to find a quarter in which the Chinese economy underperformed developed markets. And this has very significant consequences for risky assets, as I'll discuss later in the presentation. Now, what explains the slowdown? There's a variety of factors at play. Arguably, the most important one is a shift in emphasis by the Chinese government away from growth and towards financial stability. There have been increased concerns about over leverage in China's property sector in particular. There are multiple signs that the property sector might be experiencing some kind of a bubble, with property prices priced very highly relative to real incomes in major cities in China, even on an international perspective. And what the Chinese government has done is they've imposed restrictions on property developers on the amount of credit that they're able to access. They've also cut back on infrastructure spending, which is also weighing on heavy industry. And what you can see when you look at credit aggregates, for instance, or measures of infrastructure spending, is a very clear deceleration in the pace of growth versus what we had seen in the first half of 2020. The biggest impact of this has been to slow down housing market activity. The chart that you see here in front of you compares building starts in China, that would be the red line, against real property sales. Now, real property sales in China, for example, are down something like 25% versus their peak in the first quarter of this year. And you see a similar dynamic in terms of building starts. What's happening here is basically that Beijing has imposed on property developers these restrictions on the amount of credit they're able to access. And they're also limiting their ability to use land as collateral when accessing credit, which in China is the typical way in which you would actually fund these kinds of projects. And so that plus weakening consumer sentiment has really hurt housing activity, and that's had a major impact on the economy as a whole, given the size that construction and real estate have in China. As I'll show you in a moment, China's economy is very heavily tilted towards construction. It has been for 2 or 3 decades now. And so a slowdown in the housing market has a disproportionate impact on GDP relative to what it would in other countries of the world. There are also some supply side issues that are restricting activity, in particular that to do with energy shortages. In an effort to curb greenhouse gas emissions, the Chinese government has effectively restricted the supply of coal into the economy. They're basically imposed capacity shuts to domestic coal manufacturing, and also because of geopolitical factors, restricted or imposed an informal ban, if you will, on the imports of coal from Australia, which are by far the largest supplier. And this is of coal to China. And this is especially problematic to China's economy because it still has an enormous dependence of coal as a way to power manufacturing. Coal makes up something like 60% of energy consumption in China. And so this imbalance between supply and demand has basically caused electricity prices to soar in China, but also the price of coal itself to increase sharply. As manufacturing facilities that rely very heavily on power as inputs for production, or that are very energy intensive, in facing this power crunch, some factories actually shut down capacity and took unscheduled downtime, and some others were actually forced by provincial governments to take some downtime to ease some pressure on the electricity grid. The steel sector illustrates very well the impact that energy shortages are having on industrial activity. Crude steel production in China is down something like 20% over the last 5 months, which is, to give you an idea, double the rate of loss than we saw between 2008 and 2009 in China. So a very steep decline. In the case of steel, what's happening is that steel makers don't just rely very heavily on electricity for power, but they actually use coal as an input in production. And so as the price of coke or metallurgical coal went up, they passed on part of these increases onto final consumers in the form of higher steel prices, but they also adjusted production because it just became unprofitable to produce steel, and obviously that had a large impact on economic activity. What do we expect over the next few quarters? The chart that you see in front of you here is our leading economic activity index for China. It's comprised of a panel of something like 20 economic indicators for China. The idea there is to basically offer a proxy measure of China's business cycle, abstracting from industry-specific shocks and just looking at common variations across this large panel of indicators. And what's important is that this measure tends to have predictive power over GDP and alternative measures of activity like industrial production and so on. And so if you look at its evolution, it obviously skyrocketed in the second half of last year. It then plateaued in early 2021, and it's now suggesting that China is operating slightly, that economic activity has actually fallen slightly below potential. You see this by the fact that the index has actually turned negative, suggesting that the economy is undergoing a cyclical slowdown at the moment. What this translates to in terms of GDP growth is we think that the economy will grow roughly 8% in full year 2020. But much of this is actually an easy year-on-year comparison with a very poor first half of last year. If you move on to 2022, The chart that you see in front of you here shows our projections for growth for Chinese GDP in full year 2022. As Matt explained at the beginning of the presentation, the work that we do at Numera is probabilistic in nature, so we don't just focus on baseline scenarios, but we really focus on the full range of potential outcomes. What this is telling us right now is that the most likely outcome is for China's economy to grow 5.5%, but there's obviously quite a bit of uncertainty around that central scenario. One important alternative scenario to consider is the likelihood of China's economy expanding above potential. We currently estimate potential at around 6.3% for China. The probability that GDP expands at least as much as 6.3% next year is 37%, which is not especially high by historical standards. And what this is telling us is that in all likelihood, China's economy will likely underperform. Now, there's various factors at play here as to why this may actually occur. The biggest concern in our view is the slowdown in China's housing market. Just to illustrate the point that I mentioned before when showing you that chart that compared building starts to residential property sales. This scatter plot that you see in front of you compares, it basically shows you the importance of construction and real estate in China compared to other major economies in the world against the relevance of contact services as a share of GDP. In China, construction and real estate, based on our estimates from global input-output tables, they amount to something like 28% of GDP, which if you compare that to other regions of the world, it's an extremely high number. There's, for example, in the US, construction and real estate combined make up something like 15% of GDP, so much lower. And so to the extent that China maintains this pressure on property developers like Evergrande, like Fantasia, and so on, to reduce their dependence on credit as a way to stimulate construction activity, then that would have a very pervasive impact on GDP growth. Conversely, China's economy is proportionately less dependent on contact services than other major economies in the world, both in developed markets and in emerging markets. By contact services, we would mean anything that's directly exposed to mobility. So, for example, restaurants, entertainment, transportation, and so on. The relatively low exposure that China has to contact services also caps the upside because higher vaccination rates should result in improving mobility for the global economy, even in 2022, which again would improve the upside of, for example, developed market economies versus that of China, which clearly doesn't depend on this so far. We don't necessarily expect the Chinese housing market to undergo a full-fledged crisis, but there are certain aspects of the current state of affairs that we do find concerning, and that may actually result in weaker growth than we expect. Based on our estimates, there's something like 125 million unsold units, unsold building units in China. So basically, there's an enormous inventory overhang. That's representative roughly of 1/3 of China's population. And so what that is telling us is that property developers, if they don't get access to credit, may still basically reduce the existing inventory without actually adding anything to GDP. And so if that were actually to happen, then you could see economic activity in China potentially expand 1.5%, 2% versus the 7-8% plus growth rates that we're used to seeing, that we've become accustomed to seeing in the last 2 or 3 decades. From an international perspective, one important aspect to consider, and this matters especially for investments in equities, is that China's growth premium will likely narrow versus the rest of the world. The chart that you see in front of you here compares GDP growth, our baseline scenarios for GDP growth in full year 2022 for the global economy and major developed and emerging regions. The bars show you our projected growth rate, and then the dots signal the potential rate of growth. Notice that while China, which is the light green bar, will probably grow below potential, developed markets will grow considerably above their potential or trend rate of growth next year, led by very strong growth in the euro area. This means that the growth premium between China and the rest of the world will probably narrow, and this is extremely important when investing in emerging markets, which typically give you excess returns only in circumstances in which China is growing well above potential and the growth premium is actually widening. If you do a historical analysis, so we actually carried out a historical analysis on the performance of Chinese equities in periods in which China has a growth premium and a growth has an above and below average growth premium versus the rest of the world. And what we find is that on average, over the past 3 decades, in periods in which that growth premium narrowed below average, Chinese equities lost 5% compared to the rest of the world. Now, if we move on to the investment strategy side, obviously the sector that's most exposed to China of any risky asset would be industrial commodities. The chart that you see in front of you here compares that leading activity index for China I showed you earlier in the presentation to our also proprietary commodities activity index that would be the red line, which is essentially a measure of global demand for commodities versus trend. Notice that there's an extremely strong correlation between both of these, and it's very rare for commodities demand to rise significantly above trend and in periods in which economic activity in China is actually weakening. And so when you translate this into overall commodity investments, what this basically means is that the upside for commodity investments, which have obviously delivered very strong returns in the first 11 months of this year, that upside will be considerably weaker in 2022. You can see this illustrated in the chart in front of you. This is our November projection for overall commodity prices. In our reports, when we talk about overall commodity prices, we basically use the S&P's GSCI commodity commodity index as a benchmark. The projection here shows our commodity price index adjusted for inflation. The most likely outcome is actually for commodity prices to actually weaken somewhat, which is very different from the projections we were making even at the beginning of this year and certainly in late 2020, as that oil chart, for example, that Matt showed you earlier today. Now, this doesn't mean that all commodity sectors are equally exposed. In particular, the fact that China is the world's manufacturing powerhouse means that metals in particular are more exposed than energy investments to a slowdown in China. This chart here shows you, this is from a research study we carried out in late 2019, where we had simulated the impact of a housing crisis on China on commodity investments worldwide. And so the bars show you the expected impact of a 20% drop in housing prices in China, so residential property prices in China, that would be like a deep correction, on selected commodities over a 24-month period. Just to give you an idea, a 20% drop in housing prices in China would be equivalent roughly to a 15% decline in the value of overall household assets in China. In China, household net worth is very, very tilted towards properties and much less reliant on stocks and bonds, whereas the reverse is the case in developed markets. And so this would, part of the impact here would be that a significant slowdown in housing prices would act as a very negative wealth effect. And so that would have a deep impact on economic activity in China and therefore weigh heavily on industrial commodities. Notice, though, the difference between the impact on oil, for example. A 20% drop in housing prices could shave off something like 13% off crude oil prices over a 24-month horizon. The impact is much more pervasive on industrial metals. On copper, for example, that same simulation tells us that copper prices could fall 33% and iron ore prices could even fall more than that. And this is a direct reflection of the end use structure of these metals. Crude oil is heavily dependent on transportation demand. Transportation demand globally is actually slightly more tilted towards developed markets like the US and Europe, and a little less dependent on China. Whereas if you take something like iron ore and steel, for instance, China makes up by far the biggest, is by far the biggest end user of iron ore in the world. It makes up for 50% of overall demand. And if you break down steel manufacturing, for instance, by end use, you find that residential construction makes up something like 40 or 50% of overall steel demand, and you find a similar thing if you do that for copper. And so the impact of a slowdown in China's housing market is very pervasive on industrial metals. Now, iron ore has actually undergone a correction already. If you've been following developments in the iron ore market, in 2020 and early 2021, there was significant concern that the market was being propped up by traders or trader sentiment, and that it had detached from fundamentals. Our own modeling work basically showed the same thing. What you see here in front of you is a comparison between the spot price of iron ore, which is basically the price of imported iron ore at a 62% purity entering China, versus its estimated fair value. The fair value estimate is derived from our own models, and it's basically the price that is consistent with industry and economy-wide fundamentals, such as steel manufacturing, the dollar, global demand for commodities, inventory swings, and so on. And if you take all of those factors into consideration, earlier this year, essentially iron ore was trading at something like at $100 premium, which is the highest which is the highest that premium has been historically. As the steel market started weakening, that basically dented trader sentiment. There was a decline in physical consumption for iron ore. There was a rundown of inventories, and speculators basically cut back purchases of iron ore, and so the spot price collapsed significantly. This means that the vulnerability, if you will, of the iron ore market to a housing correction is less pronounced than it would have been had this happened in early 2021. In contrast, we think that copper remains extremely vulnerable to an even deeper housing market correction. This chart in front of you shows you our latest projections for copper prices. So when we talk about copper, when we forecast copper, we talk about the LME spot copper price in US dollars per ton. The spot price currently stands at around $9,900 per metric ton, which historically is extremely high. Rarely has copper actually neared $10,000 per ton. What our models are telling us is that given China's ongoing slowdown, the most likely outcome is for prices to fall well over $1,000 to about $8,500 per ton by late 2022, with only a 24% chance of prices remaining or exceeding their current level. And so this also, as I'll discuss in a minute, has deep-rooted implications for commodity exporting countries such as Chile and Peru, for instance. Moving on to the equity side of things, if you've been following the evolution of equity investments in the last year or so, or really since the beginning of the COVID crisis, early in the pandemic, Chinese equities really outperformed developed markets, benefiting from China's V-shaped recovery. What the chart in front of you shows is the evolution of foreign listed Chinese stocks, which is basically the biggest component of the MSCI China, against domestically traded A shares, which are those that are traded in yuan in the Shanghai and Shenzhen exchanges. Up until the beginning of this year, both of these essentially moved in sync and outperformed developed markets. However, starting early 2021, really in the middle of this year, there's been a decoupling between both of these. A shares are actually up marginally so far this year, so they're still giving marginally positive returns, even in a context in which China is already starting to slow down. whereas foreign listed stocks, so those traded again in overseas exchanges like in the US or in Hong Kong, for instance, in dollars, those are doing extremely poorly. Many of these are tech stocks, and they're facing extreme regulatory pressure by China itself, which is basically eroding confidence on foreign investors in these equities. And so the question then becomes, with Chinese equities, in particular offshore equities, trading at a considerable discount versus what they were in early 2020 or even mid 2020, whether it's worthwhile to actually increase exposure to China, even in a context in which the economy is likely to slow down further. Now, the lower valuation actually improves the upside a little bit on Chinese equities versus what we would have said, say, 4 months before, what we would have said in mid 2021. But the big issue for us is that measures of downside risk, which again we derive from our probability forecast models, those remain still very, very high in historical terms. What you see here is a standard metric that we show in our chart packs, which is basically a time series that tracks left tail risks on 12-month investments on Chinese equities. What this is telling you is how much you could, what this is tracking basically is how much could you as an investor realistically lose on 12-month investments on a particular asset, in this case, the MSCI China, given what you know at a particular point in time. And even today, new investments in Chinese equities, even with low valuations, could potentially face losses of over 50% over the next 12 months, which, as you can see, is very high versus its normal range. A slowing Chinese economy, as well as a gradual reversal in expenditure patterns in developed markets away from goods and towards services, bodes poorly for investments in Asian equities in general. What this chart here is comparing is, or tracking, is the evolution of, is the likelihood of you experiencing positive returns on investments in Asian stocks over a 12-month holding period. Now, typically those investments will give you positive returns, and so on average that probability exceeds 50%. It averages something like 63, 64%, even if you adjust for inflation. But the important thing to consider now is that the probability of positive returns is much lower than what it typically is. And this is a direct reflection of China's growth premium in particular narrowing versus that of developed markets. If you focus on commodity exporters, the impact of a slowdown in China is very uneven. The fact that China is slowing while simultaneously there's supply restrictions on the energy grid, basically, and basically across major energy industries like crude oil and natural gas and so on, what that has caused is a decoupling between the evolution of energy prices and metal prices. That's what the green line is tracking here, which is, it basically just shows the ratio of energy to metal prices so far this year and its evolution. And you notice, what you notice if you do this is that there's a very strong correlation between that ratio and the relative performance of EMEA stocks, so stocks in Eastern Europe and the Middle East, which are obviously very heavily dependent on oil and natural gas prices, versus investments in Latin America. There are obviously oil producing companies in Latin America, but proportionately there's more mining companies that are more dependent on the evolution of metal prices than they are on energy. And so to the extent that China's slowdown maintains this decoupling between energy and non-energy prices, then you would expect countries that are more exposed to non-energy commodities to be more exposed, such as those in Latin America. And so in relative terms, we would recommend in EM, in equity portfolios, we would recommend overweighing EMEA over Latin America over multiple holding periods. Now, this doesn't mean that you should necessarily leave Latin America fully. You may not be able to, based on your regional exposure and the regional structure of your portfolios. And so if you have very heavy holdings in Latin America, one way that we think you could minimize, or that we would recommend you can minimize foreign risk in Latin America, or risk to a slowdown in China, is basically by adopting hedged versus unhedged positions on Latin American equities, and more generally rotating towards hard currency bonds, which are proportionately less exposed to a significant slowdown in China and more dependent, if you will, on global liquidity conditions, which still remain very favorable. And so this is what this chart here in front of you is illustrating. What this is showing you are optimal portfolio weights derived from, again, our probability forecast models and our proprietary optimization tools. Basically, this is telling you, given the current macroeconomic environment, how should you as an investor position your assets in Latin America optimally 3 months out and with longer term investments, such as over a 12-month holding period. And notice that in every case, if you do hold equities, you should really be holding equities that are hedged, or that are essentially shorting Latin American currencies, just because these are very exposed to a slowdown in commodity prices. And in general, it makes a lot of sense to overweigh your positions on bonds that trade in US dollars and are not directly exposed to FX risks, such as corporate bonds, and to a lesser extent, hard currency sovereign bonds. And just to wrap up, in terms of the recommendations that we're offering our clients at the moment on how to play China's growth slowdown, this table here, which is similar to the tables that you would find at the end of our monthly strategy reports, the table is listing some of our recommendations for assets that are directly exposed to China and how we would recommend positions over the next 12 months. So, for example, we're now recommending our clients to short copper prices with a stop loss of around $11,000. The reason for that, of course, is that as China slows and also mobility improves in Latin America, you'll see the copper market balance likely worsen, and so that reduces the attractiveness of copper prices. In Latin America, so for example, if you take Chile, which is the country that's probably most exposed to China, we recommend overweighting hard currency over local currency bonds if you have fixed income funds that focus on Chile. The reason for this, again, is that if China slows down and that hurts the Chilean peso, that's going to accentuate inflationary risks in a context in which the central bank is already hiking rates. And so we expect local currency bonds to do much worse than hard currency bonds in this environment. A similar thing applies for Peruvian equities, which are obviously very heavily exposed to China's slowdown, as well as to policy uncertainty, given changes in President Castillo's cabinet recently. Broadly speaking, we think that EM equities are less attractive in the current juncture than developed market stocks because of this smaller growth premium I talked to before, and also likely because of tapering by central banks. And then in terms of playing that energy, non-energy decoupling I talked about earlier, two options we are recommending clients. The first one is to favor the Canadian dollar over the Australian dollar, just because the terms of trade differentials are more favorable towards Canada than they are to Australia, which is within the developed market space much more exposed to China than Canada, which is more reliant on energy investments in the US. And then another thing you can do is, as I mentioned before, overweight EMEA over Latin America, again, to play this energy to non-energy decoupling. So